Welcome to Market Watch, where we dissect the profound shifts shaping our global economy. For over a decade, the financial world operated under a deluge of easy money, a deliberate policy aimed at staving off collapse and stimulating growth. Today, that era is over, and central banks globally are now in reverse, aggressively draining liquidity through a process known as quantitative tightening, or QT. This shift is far more than just rising interest rates. It's a fundamental replumbing of the global financial system with potentially systemic risks. We're exploring the deep economic implications of this unprecedented monetary reversal and what it means for everything from corporate balance sheets to household budgets.
The scale of the prior quantitative easing, or QE, was truly staggering, with the Federal Reserve's balance sheet swelling from under $1 trillion pre-2008 to nearly $9 trillion at its peak. This expansion meant injecting trillions of dollars into the financial system, effectively lowering long-term interest rates and encouraging borrowing. Now, the Fed aims to shed up to $95 billion per month from its balance sheet, a sustained reduction that has already removed over $1.5 trillion in assets. This withdrawal is manifesting in higher government bond yields, tighter credit conditions, and a palpable increase in market volatility across asset classes. We are observing liquidity premiums re-emerging in corners of the bond market that were dormant for years, signaling heightened risk aversion and scarcer capital.
For many ordinary people, the era of easy money felt like accessible credit for homes, cars, and even small business ventures. Mortgage rates plummeted, credit cards were readily available, and the cost of debt felt almost negligible. However, the reversal has been swift and brutal for those carrying significant variable rate debt. Suddenly, credit card payments are soaring, adjustable rate mortgages are becoming unaffordable, and the dream of homeownership feels further away than ever for new entrants. Many families are now confronting the harsh reality of their borrowing costs escalating significantly without a commensurate increase in wages.
Central banks initiated QE as an emergency measure to stabilize markets during the 2008 financial crisis, and again during the COVID-19 pandemic. The goal was to prevent a deflationary spiral and stimulate lending when traditional interest rate cuts were no longer effective. Conversely, QT is designed to combat persistent inflation and normalize monetary policy by reducing the money supply and pulling reserves out of the banking system. For corporations, the immediate challenge has been refinancing existing debt at significantly higher rates, leading to increased interest expenses and pressure on profit margins. Many firms that relied on cheap debt to fuel expansion are now grappling with a sudden and drastic change in their capital structure.
The current liquidity drain is not merely a cyclical adjustment. It is revealing deep structural fragilities within an economy accustomed to perpetual monetary accommodation. To understand its profound impact, we must look beyond headline interest rates and delve into the underlying plumbing of the financial system. This shift is exposing vulnerabilities that were masked by years of abundant, cheap capital, leading to a re-evaluation of fundamental economic principles.
Quantitative tightening directly impacts bank reserves, which are the bedrock of the financial system's liquidity. As the central bank shrinks its balance sheet, it essentially pulls money out of the commercial banking system, making reserves scarcer and more expensive. This scarcity flows directly into money markets, increasing the cost of short-term borrowing for banks and, consequently, for businesses and consumers. We're seeing this play out in the form of higher repo rates and increased spreads in interbank lending, indicating a less liquid environment. Furthermore, many non-bank financial institutions, or NBFIs, which expanded significantly during the easy money era, are now facing funding challenges as traditional credit lines tighten. These NBFIs, ranging from hedge funds to private equity firms and even specific shadow banking entities, are critical providers of credit, and their stress can ripple through the entire system.
The impact of tightening credit conditions is particularly acute for small and medium-sized businesses, the engines of job creation. Unlike large corporations with diverse funding options, these businesses often rely heavily on bank loans or lines of credit for operational expenses and expansion. As banks tighten lending standards in response to reduced reserves, many promising ventures find themselves unable to secure necessary capital, forcing them to scale back. This translates directly into delayed hiring, frozen expansion plans, and in some cases, outright job losses across various sectors. The pervasive sentiment of growth at all costs has definitively shifted to a focus on preserving cash and managing existing liabilities.
The era of quantitative easing effectively suppressed volatility and artificially inflated asset prices, creating a perception of stability that masked underlying risks. Now, as liquidity recedes, that veneer is peeling away, revealing companies that were only viable due to ultra-low borrowing costs, often termed zombie companies. These firms, unable to generate enough profit to cover their debt interest payments, are becoming increasingly vulnerable to default as rates rise. We are witnessing a fundamental repricing of risk across global markets, forcing investors to scrutinize balance sheets and business models more rigorously. This process is painful, but necessary for a healthier allocation of capital in the long run, eliminating malinvestments fostered by years of easy money.
The unwinding of global liquidity is creating a stark divergence, separating those who benefited most from the easy money era from those now bearing the brunt of its withdrawal. This phenomenon is deepening existing inequalities and reshaping the economic landscape for both institutions and individual consumers. Understanding this growing gap is crucial for grasping the broader societal and economic implications of the current financial environment.
Data on corporate bankruptcies is starting to show a clear trend, particularly among highly leveraged firms and those in sectors that boomed during the low-rate environment. For example, several regional banks and technology startups, once heralded for their rapid growth, have recently faced severe liquidity crises or outright failures. In contrast, cash-rich mega-cap corporations, often with established market positions and robust balance sheets, are navigating this period with relative ease, sometimes even acquiring struggling competitors. This creates a bifurcated credit market where large, stable entities can still access capital on favorable terms, while smaller or riskier enterprises face prohibitive costs or outright denial.
For consumers, the impact of the liquidity drain is a painful double whammy. Persistent inflation continues to erode purchasing power, while borrowing costs soar. Credit card debt in the U.S., for instance, has surpassed historical highs, with many households now paying double-digit interest rates on their outstanding balances. The wealth effect of easy money, where rising asset values made people feel richer and thus spend more, is now reversing, leading to reduced discretionary spending. Many homeowners locked into historically low mortgage rates are reluctant to sell, creating inventory shortages and further dampening an already struggling housing market. The prospect of significant purchases like a new car or home now seems dauntingly expensive for the average family, impacting long-term financial planning.
Institutional investors, from pension funds to endowments, are grappling with the evaporation of liquidity premiums and the repricing of long-duration assets. Many pension funds, historically reliant on steady returns from bond portfolios, are finding their liabilities increasing as discount rates rise, necessitating a re-evaluation of their investment strategies. Banks, responding to regulatory pressures and heightened risk perception, are significantly tightening lending standards across the board, particularly impacting small and medium enterprises. This shift from a search for yield at all costs to a search for safety is reorienting vast sums of capital towards less risky, shorter duration assets. Corporate boards are prioritizing debt reduction and cash preservation over aggressive expansion, reflecting a more conservative and cautious outlook.
As central banks continue their unprecedented unwinding of easy money, the forward macro projections present a complex and often precarious outlook. The path ahead is fraught with potential landmines, requiring a delicate balance between controlling inflation and avoiding a systemic financial collapse. We must consider the interplay of monetary policy with fiscal challenges and the global reverberations that could reshape economic alliances and power structures.
The potential for a deeper credit crunch or a significant recession looms large if quantitative tightening continues unabated without market accommodation. We are observing leading economic indicators, such as the inverted yield curve, flashing recession warnings with increasing frequency and intensity. Furthermore, The interaction with massive government debt issuance, needed to fund persistent deficits, creates additional pressure on bond markets and could crowd out private investment. The question remains whether central banks can engineer a soft landing, where inflation is tamed without triggering a severe economic downturn, or if a hard landing is inevitable. Key indicators to watch include bank lending surveys, corporate earnings reports for signs of distress, and, crucially, employment figures as a barometer of the real economy's health.
For consumers, the future implies a continuation of austerity, necessitating increased savings and a further reduction in discretionary spending. Households will likely prioritize debt reduction and essential expenditures, impacting sectors reliant on consumer discretionary income, such as retail and travel. There is also a tangible risk of social unrest if wealth disparities continue to widen, as the burden of higher costs disproportionately affects lower and middle-income households. Policy responses, or lack thereof, to address these widening gaps will significantly influence future consumer sentiment and overall economic stability. The psychological shift towards frugality and caution may persist for years, shaping consumption patterns long after the immediate crisis has passed.
Central banks face an incredibly delicate balancing act, continuing their fight against inflation while simultaneously monitoring for signs of financial instability. The possibility of a pivot, where central banks are forced to halt or even reverse QT due to market dislocations, remains a constant point of speculation among investors. Globally, the implications are significant, with spillover effects on emerging markets experiencing capital flight and currency volatility as the dollar strengthens. Countries with high dollar-denominated debt, like Turkey or Argentina, face immense pressure as their repayment burdens swell. Ultimately, this era underscores the necessity of robust structural reforms, including prudent fiscal policy and resilient banking regulations, to better prepare the global economy for future cycles of monetary tightening.